Welcome to Hibiscus Petroleum's third quarter 2017 earnings webcast. This webcast presents an overview of the results reported as part of the quarterly financial report for the 3-month period ended 31st March and released today on the 24th of May 2017. This webcast has been prepared by Hibiscus Petroleum Berhad, i.e. the company, solely for general information purposes only and shall at all times be heard and or viewed subject to the full quarterly report made available or published by the company on its website. This webcast may contain forward-looking statements which are based on current expectations, beliefs, and projections about future events or matters. By listening to and or viewing the webcast, you agree to the limitations and notifications set out in the disclaimer section of this webcast. There are 5 parts to this webcast. Pascal Hoss, Vice President of New Ventures and co-founder of Hibiscus Petroleum, will take you through a brief introduction of the company in Part 1. Yip Chi Yong, or CY, Vice President of Finance and Group Controller, will then provide an overview of our key asset, the Anasuria Cluster, in Part 2, and will follow up with highlights of the company's third quarter results in Part 3. In Part 4, Pascal will briefly touch on details of our proposed acquisition of a 50% interest in the 2011 North Sabah Enhanced Oil Recovery Production Sharing Contract. CY will then conclude with some of our key messages in Part 5. Should you have any queries, you may contact our Investor Relations team via the email address provided at the end of this presentation. I shall now pass you on to Pascal.
Hello, this is Pascal Hoss, Vice President of New Ventures. Let me commence by providing you with a brief background of our company. Hibiscus Petroleum was listed on the main market of Bursa Malaysia in July 2011. Today, we remain as Malaysia's first listed independent oil and gas exploration and production company. We listed with the intention of being involved in both exploration and production activities. In 2014, with the advent of U.S. shale-related oil production causing an oversupply in crude oil and consequently a drop in oil price, we have refocused our goals towards growing our business by revitalizing mature producing assets safely and profitably in regions of our geographic focus. Our joint ownership of the Anasuria Cluster of fields in the UK North Sea in this regard is consistent with our goals and is significant in generating cash and profit for the company. We produce an annual average of more than 3,500 barrels of oil equivalent net to our company on a daily basis. Our current portfolio of assets is spread across 2 geographical locations, i.e. the United Kingdom and Australia. A third asset has been conditionally secured in Malaysia, but is currently subject to regulatory approval prior to working interest being transferred to us. Upon completion of the Anasuria transaction on the 10th of March 2016, our total 2P oil reserves significantly increased to circa 26 million barrels. This consists of 6.5 million barrels of proven undeveloped reserves located in the Vic L31 West Seahorse asset in Australia, and about 19.2 million barrels of proven developed reserves located within the various fields of the Anasuria Cluster in the UK North Sea. CY will go through this in more detail in Part 2 of this webcast. Moving into Slide 7, we are happy to note that our efforts to maintain high standards in corporate governance have been recognized. As presented in our previous webcast presentation on the financial highlights of the second quarter ended 31st December 2016, Hibiscus Petroleum was placed in the top 9% of companies by Bursa Malaysia in an analysis on corporate governance, disclosure, and standards. Moving forward, we will continue to uphold a high level of corporate governance and transparency by keeping our stakeholders engaged with the company's activities and informed of our performance on a timely basis.
Hello, I'm CY, Vice President of Finance and Group Controller. I'll now take you through some information on our key asset, the Anasuria Cluster, located in the UK. To recap, we completed our acquisition of the Anasuria Cluster from Shell and Esso on the 10th of March last year. This means that we have held the joint operatorship of Anasuria for over a year now. The Anasuria asset is located about 175 kilometers east of Aberdeen and has been producing since 1996, with an estimated remaining economic life of approximately 20 years. Our interest in the Anasuria Cluster comprises a 50% interest in the Teal, Teal South, Gilmore A, and Kite fields. We jointly operate these fields, along with the FPSO, together with our partner Ping Petroleum. The cluster also includes the Cook field, and we have a non-operated 19.3% interest in this asset. Included as part of the acquisition price of these assets were all the installed subsea production infrastructure and the floating production storage and offloading vessel, the Anasuria FPSO. Taking a look at the field layout, the subsea infrastructure underpinning the production of hydrocarbons is quite extensive and spans 25 kilometers from north to south. Our confidence to jointly operate this asset is derived from the existing knowledge and experience of Hibiscus personnel, some of whom have previously worked in the UK North Sea environment. Operating risks are further mitigated by the fact that we also utilize the services of Petrofac, a reputable service provider, in the role of offshore duty holder. That said, the financial performance of our Anasuria asset is subject to a few external factors. We are exposed to movements in oil and gas prices. Foreign exchange rates also play a role as we recognize our revenues and valuation of Anasuria in US dollars, while the bulk of our operating costs for the asset are incurred in British pounds, but as a Malaysian listed company, we ultimately report our results in ringgit. As we can't control the previously mentioned factors, we focus our efforts in managing the production performance of the wells, facilities uptime, and operational costs of the Anasuria asset. I would like to review our operations for the period from January to March 2017. For the quarter, we recorded an average daily oil production rate of approximately 2,600 barrels a day. Together with gas exported, our total oil equivalent production rate for the quarter is an average of approximately 2,900 barrels a day. Even with a lower than expected production rate during the quarter, the average daily oil equivalent production rate achieved for the financial year to date of approximately 3,500 barrels per day remains above planned production rates for the year. The average facilities uptime for this quarter was 76%, and the total volume of oil sold during the quarter was about 273,000 barrels of oil. The realized oil price for oil sold was approximately $53 a barrel, which is the highest realized oil price achieved by the company to date. The improved price levels being achieved now are probably a result of the compliance demonstrated by OPEC members towards meeting promised cutback in oil production levels. Further to this, the operational expenditure remains low, with the OPEX per barrel for the quarter maintained at a level below $20 a barrel. We recorded a lower average daily production rate because planned and unplanned shutdown of the facilities negatively impacted operational uptime. In addition, the gas-oil ratio readings of one of our main producer wells increased substantially. Thus, production flow from this well was temporarily reduced to minimize unnecessary loss of reservoir pressure and prevent any detrimental impact on long-term recovery. Both these issues were resolved towards the end of the third quarter, and production has been restored to normal levels. In order to build more resilience into our production system, we are implementing production enhancement projects, which are of low technical complexity and business risk. In the fourth quarter of this financial year, we will also restart production from Gilmore P1 well, which was shut in by the previous operator due to high H2S readings. We plan to produce from this well by increasing the injection levels of the appropriate chemicals to safely control the levels of H2S produced along with the oil. Shortly after this project, we will introduce gas lift to the Gilmore P5 well to increase the oil production levels from the well. I will now take you through the financial highlights for the quarter. In the third quarter ended 31st March 2017, the Anasuria segment reported earnings before interest, tax, depreciation and amortization, or EBITDA, of approximately 40 million ringgit. This represents a 5% increase from the preceding quarter. The EBITDA margin of 59% in Q3 is fairly similar to the level achieved in the previous quarter. The Anasuria segment has contributed profit before tax of 44.8 million ringgit for the 9 months ended 31st March 2017. Whilst profits are extremely important, management's focus remains on delivering strong and sustainable EBITDA levels going forward. Over the past few quarters, our balance sheet has been gradually strengthening. We have built our total assets and shareholders' funds to 1.3 billion and 753 million ringgit respectively. In addition, the group continues to remain in a debt-free position. You will also recall that when we purchased the Anasuria Cluster of assets, there was a component of the total purchase consideration of $52.5 million, amounting to $22.5 million that was deferred. On the 10th of March this year, we fulfilled a payment obligation of $15 million towards this deferred consideration component. Therefore, only $7.5 million remains to be paid on the 10th of September this year. I'll now pass you back to Pascal to provide a brief recap on our proposed acquisition of a 50% participating interest in the Malaysian 2011 North Sabah Enhanced Oil Recovery Production Sharing Contract, or PSC.
In October last year, we announced an exciting new proposed acquisition when we entered into a conditional sale and purchase agreement with Shell. This was to acquire Shell's entire 50% participating interest in the 2011 North Sabah Enhanced Oil Recovery Production Sharing Contract, or PSC. The SPA also includes interests in the joint operating agreement currently between Shell and Petronas Carigali in relation to the PSC. This transaction marks our second deal with Shell internationally and is consistent with the group's strategy of having interests in producing late-life fields in safe jurisdictions. We are currently awaiting partner and regulatory approvals. The North Sabah EOR PSC has been producing since 1979 with production rights up to 2040. The deal includes the operatorship of 4 producing oil fields offshore Sabah, the Labuan crude oil terminal, and all other equipment and assets related to the PSC to be transferred to Hibiscus Petroleum. As reported by Shell, at the end of 2015, the asset had an average daily production of 18,000 stock tank barrels per day. Our independent valuation performed by Risk Operations Private Limited estimated the asset to hold 62 million barrels of remaining reserves and 79 million barrels of contingent resources. Overall, we believe this asset holds a great deal of potential. Before we wrap up, I would like to pass you back to CY to highlight a few takeaway points.
We have resolved the operational issues that contributed to a lower than expected operational performance for the quarter and have put in place several projects to build more resilience to the overall production system of Anasuria. In March this year, we fulfilled our obligation of $15 million to Shell and Esso for the first tranche of the deferred consideration as part of the transaction to acquire the Anasuria asset. In the meantime, Anasuria continues to generate positive cash flows to the group. Strong cash flows and profits for the third quarter of ended 31st March this year from Anasuria were derived from higher realized oil price and a sustained low operational expenditure per barrel. Building on this capability, we have identified several longer-term projects that will enhance production volumes in Anasuria by bringing on stream petroleum resources that have already been discovered. We intend to fund these value-accreting projects by leveraging on our debt-free balance sheet. From an industry perspective, the proposed listing of Saudi Aramco could be a catalyst of maintaining oil price stability and thus result in a positive impact on our overall financial performance. The industry is closely following the sentiments around the upcoming OPEC meeting. Decisions that will be made during this meeting could result in a rebalancing of supply and demand forward curves, which will bode well for our company. And that's all we have for this quarterly earnings webcast. Thank you for tuning in.